You ever wondered about annuities? Are they good? Are they bad? Annuities can be complicated financial instruments. Well, you're going to want to stay tuned today, folks, because today we're going to tell you the truth about annuities.
Retiring well, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring well, where we believe your best is yet to come.
Hi, welcome. Listen, today we're talking about annuities. The truth about annuities. Are they good or are they bad? Listen, before I get started on, I just want you to understand, financial instruments are just tools. All right, probably the best way for me to illustrate that is think of this way. Let's say that I had a piece of wood and I want to cut that piece of wood in half and I'm holding a hammer. How much success am I going to have? Not much, right? Let's say I have two pieces of wood and nail and I want to connect them, all right, and I'm holding a saw. How much success am I going to have? Not much, right? Listen, all financial instruments serve a purpose under certain circumstances, and in those certain circumstances, they might be a good thing. But maybe in another circumstances, they might not be a good thing, right? So understanding the pluses and minuses of any financial instrument will help us in determining whether it's good for us. And that's really what it comes down to, is what are we trying to accomplish? What are our goals? What are our objectives? And then do those financial instruments meet those objectives and goals? All right, so let's talk about annuities today. All right, I'm going to give you an example of what's called an immediate annuity. All right, now I'll bet probably 99.9% of you out there, as I explain what this is, was going to think this is an awful financial instrument, okay? What an immediate annuity is a lump sum of money you give to an insurance company, okay? This is an insurance product. You give the insurance company this lump sum of money, and then they give you a guaranteed lifetime payout for the remainder of your life, and possibly your spouse's life. Now, so far sounds pretty good, right? And this payout can sometimes be fairly handsome. But here's a caveat. If you die, and you die particularly early, guess who gets to keep the money? Who gets to keep the rest of the money? The insurance company. Now doesn't sound so attractive, does it? But think about it. All right? Think about it. What if you're a married couple, you have no kids, you have no charitable bequests, all right? If you ask this person, this couple, what they wanted in their plan, they tell you, we just assume bounce the check to the funeral home when we pass away, right? They don't care to have anything left behind when they pass away. Would this financial instrument called an immediate annuity maybe appeal to them? Might so, because if they died early, they could care less if any of it went back to the insurance company. You see, now 99.9% of us might not like that financial instrument, but there is a certain situation where somebody might like it. Okay? So this is how financial instruments can be. Now I'm going to give you another example of an annuity. This is a different kind of annuity. It's called a fixed annuity. Now a fixed annuity, liken it to like a CD with a bank. Okay? Except it's not with the bank now, it's with an insurance company. All right, you give them a lump sum amount, and the insurance company is going to come back just like a bank does with a CD, and they're going to say, we're going to guarantee you can't lose your principal. All right, and just like a CD, we're going to give you a guaranteed interest rate. Okay, one you can count on through the life of this contract, which can be a number of different years. It can be 3 years, just like a CD. It can be a 4-year, 5-year, 6-year. But basically, they're going to guarantee your principal and then give you a guaranteed interest rate. Now, no moving parts here, right? I know what my principal is going to get paid back. I know how much interest I'm going to make during this period. But what's the drawback to it? Well, just like a CD, it's the time frame in which they want you to be committed to this financial instrument. Again, if it's 3, 4, 5, 6 years they want you to be committed, if you try to take it out early, most likely there's going to be a penalty associated with it. Now, typically the longer you let them hold it, the more interest they're going to give you. So that might be the benefit, but the negative is the product is locked in for a period of time. So folks, this is just two kinds of annuities we've talked about. I'm going to talk about in the next segment a couple other different kinds of annuities, and we'll see whether you think they're good or bad, again, depending on what you're looking for. And if you're somebody that holds these kind of financial instruments, we'd be glad to take some time and show you what you actually have, whether it's good for you or not. So give us a call.
Are you an employee who's participating in a 401k plan? Are you aware that in some cases you might be able to roll out of the plan even though you are still working? Are you tired of the choices you have and possibly the lack of professional help in getting you to your retirement goals? If you're looking for an alternative approach to help you protect your hard-earned retirement savings, then we might be able to help. You may be entitled to an in-service rollover of your 401k plan. A rollover to a self-directed IRA may be an appropriate solution for you. Contact us at Centennial Wealth Advisory today. Take control of your retirement. Centennial Wealth Advisory can help. Please call the number on your screen.
Hi, welcome back. Now listen, in the first segment we talked about two other kinds of annuities. One called an immediate annuity. That's where the insurance company takes a lump sum and then gives you a guaranteed payout for the remainder of your life. But if you die, guess what? They keep the difference. They keep the rest, right? We talked about a fixed annuity, likened that to like a CD. They give you a guarantee your principal, they give you a guaranteed interest rate, but like a CD, want you to keep it there for a number of years, whether that be 3, 4, 5, 6 years, right? What I want to talk about in this segment is two other kinds of annuities. One is called a fixed indexed annuity. Now, it's like a fixed annuity I talked about earlier. They guarantee your principal so you can't lose, but instead of giving you a guaranteed interest rate, they're going to tie your interest to an index. So, for example, one fixed index annuity might tie the interest to the S&P 500. Okay, they might say in any given year, if the S&P 500 is up, we're going to let you participate in so much of that up. But if the S&P 500 is down, you don't have to participate in any of the down, because remember, your principal is guaranteed. Now, the kind of indexes that the fixed index annuities might tie to is numerous. It can be a number of different kinds of indexes. They might say, I told you how they might let you participate in the upside. Some might put a cap on how much you make. Let's say you're tied to the S&P 500 and the index is up. Well, one might say, we're going to let you participate in such a certain percentage of the up. Another one might say, we're just going to give you everything in that index, but we're going to cap it at a certain amount. So let's say they say that's 6% of the S&P 500. If the S&P 500 made 10%, they're going to give you 6. If the S&P 500 was down, again, 0, your principal is protected. So that's kind of how a fixed index annuity works. And then a lot of these fixed index annuities will let you purchase what they call riders. Okay, you can have a guaranteed death benefit associated with it. So the death benefit might step up and increase a certain amount every year and is guaranteed to be a certain amount. You might have a guaranteed income benefit, where that income benefit is going up every year by a guaranteed amount and then has a guaranteed payout at the end. Liken that to maybe like a pension, where the number of years you worked and the amount you made determined your benefit. Now it's an investment that's kind of guaranteed. The drawback to some of these riders, as they call them, some of these benefits that are associated with it, is there's a fee for them. So they got two sides of the picture now, or there's two sides of this financial instrument. There's one that's got just the investment side, which I talked about, guaranteed, maybe tied to an index, but then you got this other side where it's giving you these guaranteed income benefits, but you're paying for those benefits. That fee is going to come out of the investment side. So you have to be very careful when you have these fees associated with it. Are these benefits I want or don't want? So very critical to understand exactly what you have. Now another kind of annuity is what they call a variable annuity. Now a variable annuity is a little bit different because on the investment side, instead of tying your interest to like an index, like a fixed index annuity would, they have a number of what they call sub-accounts. They're likened to almost like mutual funds, except they're held with the insurance company. They now call them sub-accounts, and there's a number of different things you can pick from, just very similar to mutual funds. The drawback to a variable annuity, though, on the investment side is if the market goes down or those different funds don't do well, it can go down in value. Your principal is not protected like it is maybe with a fixed annuity. So very important to understand that. Now, they also have another side associated with them, which is these guaranteed income benefits, possibly a guaranteed death benefit, but again, fees associated with them. You got to know if they're good or bad for you. So folks, as you can see, these annuities, they can be complicated. They have a lot of different benefits, maybe some guarantees, maybe not. Understanding them is very important. So if you're somebody that has some of these financial instruments with these insurance companies, then if you want to understand them, then I encourage you, give us a call. I can't tell you how many times we've sat down with clients and explained the benefits with them, and then at the end they were able to ascertain whether it was still good for them or not. So I encourage you, give us a call. We'd be glad to help you with them.
If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
Here at Centennial Wealth, when we talk about your best is yet to come, what we're really referring to is that retirement is different today.
Retirement represents a fundamental change, yet most people don't match that with the fundamental change in their investments. Too often we see couples and individuals sticking with the same strategy that got them to retirement and not adjusting to a plan that will get them through retirement.
People who retire today are living 20, 30 years. And when you have that kind of time frame, you have the time to pursue the things that are meaningful to you, that are fulfilling to you.
In looking at your retirement income, you're no longer drawing a paycheck from the company you work for. Instead, you have to be the provider of that income. You don't want to leave this to chance, so we help clients evaluate all of their options to help provide the best solution based on their needs.
Most people in their working years put money into IRAs and 401ks because they wanted to push the tax off to their retirement years when they expected they would be in a lower tax bracket. Far too often, though, they find themselves in the same lifestyle, in the same bracket, and all they did is kick the can down the road.
Well, I'm happy to share with you, we have helped guide hundreds of families past that point into a future that is absolutely bright.
Although it's not fun to discuss, it's vital that we evaluate your life insurance and long-term care planning. The insurance world changes regularly, and you need to know that we're keeping you abreast of today's ever-changing environment.
The three biggest threats to our retirement savings is what we call the hit list. There's healthcare, inflation, and taxes. People can't afford to run out of money, so they have to plan for these things.
If you make smart choices about your money, then you have nothing to worry about.
No retirement plan is complete or properly constructed unless you have an estate plan in place.
We will regularly bring in an estate planning attorney to speak with our clients to ensure that their estate planning is structured properly.
Today we see people with Social Security, no pension, and everything else in their retirement savings. The challenge is to turn that savings into retirement income that can last their lifetime, not subject to market fluctuations.
We want you to be confident. We know you can be confident. We've done it before. We can do it for you.
Hi, welcome back. Today we're talking about annuities and the differences and the different kinds of annuities that are out there. And understanding the characteristics of annuities is very, very important. Now, in the last segment, I was talking about fixed index annuities, variable annuities, and some of the similarities they had, but some of the differences. So I know these are complicated financial instruments, but usually it's better for me if I draw that up and show you kind of how it works. But getting back to what I was talking about with fixed index annuities, okay? Fixed index annuity, again, the principal is protected. The interest that you're going to make on it is going to be determined by some index. And I use the example of an S&P 500, right? This side is what we call the investment side to a fixed index annuity. It's what they call the accumulation value, all right? Now, if it's going up but never can go down, this is just going to be continually going up year after year after year, but in any year when the S&P 500 is down, it's not going to be down. Now, as an investment instrument, I can just keep that side and have it just simply for that. But I talked about these riders you can buy, okay? There's another side to it potentially if I buy these riders that give me what's called a guaranteed withdrawal income benefit. Typically what these are going to look like is they're going to allow for an income benefit to grow each year by some guaranteed amount. Or they might say, depending, it might be as a percentage of what this side makes. Like, okay, we're going to give you 150% of what that makes. Or it might just be, okay, we're going to grow it by 7% every year. It all depends on the product itself and what they're offering. So you got two sides. You got accumulation value, think of that as the walk-away money, at any time I can take away, or this other side that may be working for me. But what's the drawback? The drawback is that to have this guaranteed income benefit, they want to basically charge this side a fee. Okay? So this side might not go down, but if there's a fee being associated with it, it could go down for the fee. The other thing you have to understand about these kind of annuities is, like the fixed annuity I was talking about in the earlier segment, there's time frames in which they want you to be committed. It may be 8, it might be 10, it might be 12 years. That's obviously a drawback because I'm committing to this financial instrument for quite some time. Now, they will allow situations for you to take money out without a penalty. All right, or without having to wait the whole time frame. It might be things like long-term care, terminal illness, these kind of things. But you're going to want to know what those are because this is a negative with these kind of financial instruments. Now, talking about the variable annuity, okay, a little bit different than the fixed index annuity because on the accumulation value side, your principal is not guaranteed. It's going to have a number of investment options you can pick from, but they can go down in value if that particular fund doesn't cooperate, if the market doesn't cooperate. So, it's got an accumulated value side. Think of it just simply like an investment. It is also the walkaway money, the money in which you could take away. Now, I should note that when I talk about the walkaway money, that might be the case, but if there's a penalty associated with it, meaning I'm trying to take it out before I meet those time frames, well, with what they call these surrender charges, I'm not going to be able to walk away with everything I thought I was going to be able to walk away until I meet those time frames. But like the fixed index annuity, the variable annuity has a guaranteed withdrawal income benefit side, all right, that may also be guaranteed, okay? It may go up 5%, maybe 6%, 7% every year. But you got to understand, this side with both a fixed index annuity and a variable annuity is not walkaway money. It's just a number by which is growing at a guaranteed rate, and then when it reaches a certain level year after year, if I ever want to trigger it for income, it's going to be based on that number, and they're going to give me a percentage by which I can pull it out. Again, both sides of this is not walkaway money. It's just a number by which they use to determine what a benefit's going to be. And also, like the fixed index annuity, to have that benefit, they're going to charge a fee. So very important to understand what that fee is, because it's going to be coming out of the investment side. So folks, I know these are complicated financial instruments. At Centennial Wealth, we sit down with people all the time who come in, bring these in and say, you know, what do I have here? Is it good or bad? Well, it's going to depend, right, on what you want, what you're trying to accomplish. But we'd be glad to sit down with you, show you what you have, show you the pros and the cons of it, and see if it meets your needs. So I encourage you, give us a call. Listen, if you were diagnosed with a life-threatening illness and the doctor was prescribing a life-saving procedure, wouldn't you get a second opinion? Sure you would. Well, how much more so for your retirement savings, which you've worked so hard for? Listen, we've watched the market drop to half its value now the last couple decades. We're now entering a rising interest rate market, which is going to bring downward pressure on bonds. Where do you go? Listen, with these new market realities, this is a time when times are good, when the outlook is good in the short run, to go out, get a second opinion, and make sure you're positioned properly for any market. I encourage you, give us a call. We can take a look at what you have, we can see whether you're positioned properly, and make recommendations accordingly. So give us a call.
Retiring Well is now also airing on radio, bringing you insights from Northern Michigan's financial advisors specializing in retirement planning. Every Sunday at noon on WTCM AM 580. Don't miss Retiring Well Radio, every Sunday at noon on WTCM AM 580.
Are you drawing closer to retirement or already retired? Do you feel confident that you have a plan in place for your retirement? At Centennial Wealth Advisory, we believe there are a number of areas within your retirement plan that must be working together. It's very important that you have a long-term income plan. You don't want to run out of money in retirement, and we believe that tax planning should go hand in hand with your income planning. So we have our very own accountant on the team to assist you. We also believe that you need to have your estate planning in order to ensure that your assets are left behind to your loved ones and/or charities. Along with that comes insurance planning, whether that's life or health. Along with all of this, obviously comes your investment planning, which you need to have confidence will help you accomplish your goals and objectives. As you can see, there's a number of areas that you need to be taking into consideration when it comes to your retirement planning. We'd love the opportunity to share with you how we approach all of these areas within your retirement plan. Please call the number on your screen.
Hi, welcome back. Listen, today we're talking about annuities, and I'm joined here now with by Art Canfield, one of the senior advisors, partner here at Centennial Wealth. And Art, I was explaining to our audience, the different kinds of annuities. I told them about immediate annuities. We talked about fixed annuities, variable annuities, fixed index annuities, and it isn't funny. When there's all these differences and all these kinds of annuities, most generally when you're talking to people, all they do is have a comment about annuities in general, right? They think they hear the word annuity and it's either good or bad, but they have no clue what they're really all about.
Right. No, it is amazing that, you know, they hear that word annuity and they just think there's one annuity for everything, right? You know, I think of an annuity like if you go to get your car worked on by a mechanic, they don't just have one tool that they pick out of their toolbox to work on something, right? They'll have a huge toolbox that they will do for various things. And annuities are really no different. They're, you know, if you want something, annuity to do a very specific thing, let's say spit out income, you may lean one direction. If you want something for principal preservation or growth, you may go another direction, right?
Right, right. How many times have people come in, they've got their investments, they kind of slide them over to us and they go, okay, is that good or bad? Right? And I typically will say, wait a second, before we even look at that, what do you want those to do for you, right? You know, what is it you're hoping those accomplish for you? Then we can take a look and make sure that those financial instruments meet their goals and objectives, right? Or meet at least what they wanted to have happen.
Yeah, absolutely. Because you may have two people have the exact same investments and slide them across, as you say. One may be perfectly appropriate, another one could be absolutely awful, but until you know what they're trying to accomplish, that's really what matters the most.
Right. The other danger I find is not understanding the intricacies of an annuity. Right. I explained to the audience, you know, how there's an investment side and there's a guaranteed income benefit side. Right. But when this insurance agent, whoever it might have been that sold them this insurance product or annuity, the only thing the person heard was guarantee. Right. They heard guarantee this, guarantee that, and so they're thinking, on their investment side, it is guaranteed, and in some cases, it's not.
Absolutely. I think probably 7 out of 10 times or maybe more folks come in with some of these annuities, and you're exactly right. Whether or not, unfortunately, they were misled by that or they just heard what they wanted to hear and hearing those guarantees. And then an example like the end of the fourth quarter of 2018 rolls around and they see their actual cash value drop in some variable annuities, and they said, wait a minute, I thought there was guarantees involved. Well, got to look a little deeper and really dive into the product to see what those are. And in so many cases we learn that isn't appropriate. They maybe weren't looking for that guarantee that they offered. They thought it was for something else.
Right. The other one I think of is that person who maybe bought that rider on a fixed index annuity for that guaranteed income benefit, or they got a variable annuity that had the guaranteed income benefit, and they thought that they thought when they heard guarantee from the investment side that was going to be good for them. Well, when you start going into the details about it and you show them that, listen, on that guaranteed income benefit side, that's not walk away money. That's not money you can take home with you. You know, all that is setting up setting up the math and how they determine what your guaranteed payment is going to be, right? But a lot of times we'll explain that to them and they'll look at it and go, I don't even care about guaranteed income benefit. I've got plenty of income over here. Why did they put me into this?
Mm-hmm. How many times have we seen people come in, Larry, where they have, like you said, great income, Social Security, pension, they're not even planning on touching these retirement assets, and they have this income rider that they're really stuck with, right? Because maybe the cash value dropped and now they're looking at these values and they're saying, okay, really the only way to get my value back out of this is I do got to take this income. Yeah. And now that may raise tax questions and other stuff.
Yeah, the one I hate to see is when I've seen somebody maybe get a variable annuity, okay, and it's got this guaranteed income benefit that's up here, all right, that's good if that's what they wanted, right? But then maybe they had this investment back in '08, and on the investment side, it is way down here. Right. You know, so they got this here, which they can't walk away with. They got this here, which they don't want to walk away with because they'll take a loss. And they're really stuck with this financial instrument because the only way they're going to get any benefit out of it is to trigger the income benefit.
Absolutely.
So, yeah.
Well, folks out there, if this is anything where you are interested in, if you have annuities that maybe you don't understand or want a second opinion on, give us a call. We're happy to sit down, walk through those instruments with you, and educate you on exactly what they are, what the benefits, and maybe what the disadvantages are. Hope you enjoyed the show this week, and we'll catch you back here next week on Retiring Well.